Joining us now, Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management, in studio. Welcome. I'm not going to grill you on Jamie Dimon's comments just yet.
He's going to grill me on them later. That's what's gonna happen. Don't worry.
Thank you, Andrew.
You rightly point out that some of it came home. A couple of chickens came home to roost with the AI valuations. Mm-hmm. Is that going to continue, or do you just try to focus on other areas of the market you feel more comfortable with, or do you make a decision to step back in when there's a pullback?
So I think in our conversations with clients, there's no real debate around whether AI is a transformational technology.
Right.
It's really much more how over-extrapolated it already is and staying ahead of the next waves of that investment. So I think in terms of the Magnificent Seven, earnings last week were a really important hurdle to have crossed. We still see extraordinary over 20% earnings growth in the group. And importantly, we do see monetization of it, for example, with cloud revenue growing 25% year over year. But you're already in the next phase for those hyperscalers, whereas there's a lot more differentiation in stock reaction after these magnificent earnings are reported. So this continuation of dispersion within the early winners of the AI story is really here to stay. The second piece that we talk to clients a lot about is actually what Jensen Huang was referring to there, which is around all of the other physical infrastructure you need for this, and specifically the power electricity question, which undoubtedly, with China having just less constraints around this,
right,
and the type of energy used and upgrading the grid system that they have, which is already more modern than ours, is a step ahead. And we worry that really the constraint for all of this adoption of AI is the electricity power question. So there's a lot of interest in investing in solutions here, especially in private markets and infrastructure funds, especially in contracted power companies, as well as those that are working to actually upgrade the grid, which we haven't done in decades and decades.
You could even tie, I guess, not just is it subsidized in China, but they don't have the emission regulations that we still have, that maybe Bill Gates wants to get rid of by now. But they're building coal plants.
Bad, but okay.
They're building. He should. He'll get there. But they're building coal plants. I don't know how many a week. It's some unbelievable number. We can't do that. We can't build nuclear really either quickly enough.
I think for China, it's very early on a realization that, yes, they also do have energy transition goals and a certain concern about how polluted things were getting and the quality of life. But they, still are very much.
Well, you're talking about particulate pollution.
Yes,
you're not talking about CO2.
No,
I mean, they could care less
just
about
the right. Fog and pollution that you saw everywhere.
That's bad stuff. Yeah, that's bad stuff.
But they do take in all of the above solution, right? It's still coal, and understanding that it'll take time to phase that out. It's nuclear, really, that's in China, where we're seeing the opening of new nuclear plants. It's their leadership in certain renewables, especially solar and batteries. And, of course, it's your traditional fossil fuels like natural gas and oil. And I think here in the U.S., it's two conversations. It's the source of the power and how natural gas has a really important role to play there before we have full renewable solutions here that are reliable and stable. But it's also the grid, the actual transmission of that power. And we have not upgraded the grid in decades.
So for positioning a portfolio, you would tell clients that the promise of AI is equal to the internet. It's a multiple of what the internet delivered, or it's 0.5 what the internet delivered. Because if it's 3 or 4 times the way the internet changed our life, then you just have to be willing to wait things out and maybe buy during pullbacks, don't you? Even if it is overvalued. Yeah,
and I think...
Are you telling people to do that? Stay in this stuff?
We're saying, especially in the U.S. market and certain Asia markets, that it's much more about the structural stories, AI being the main one here in the U.S., rather than trying to make a bet on the cyclical recovery of the economy. And we really don't think it's the time for small caps or consumer names. Let's lean into the AI story. But that evolves over time. And so a much more active focus when it comes to tech and growth funds, because there is more dispersion in those large companies. And think outside the box here, not just in public markets where you are seeing industrials as well as utilities top of the leaderboard now because of that AI infrastructure. But look at private markets and specifically infrastructure funds. That's where you're going to have your regulated and especially contracted power companies that are hopefully going to solve some of these bottlenecks for us. And it's a combination of public and private money. We can't just expect state governments or the federal government to fix this bottleneck for us.
No free lunches, because stable companies with consistent earnings are at 8 times earnings. These things, some of them are at 220 times earnings.
I'm voting for her, by the way.
For
whatever she
wants to run for.
Really? Pretty much.